Hello everyone, welcome back to my channel. Today, let's talk about entrepreneurship. Entrepreneurship is on a rise in India. Over the course of last decade, there have been numerous examples of startups that have been founded, got funded, and some of them have even been successfully listed on the stock exchanges. Along with the startups, there also has been a steady rise in venture capital and private equity industries. These are the industries which provide capital to entrepreneurs to grow their business. This capital is used by startups in multiple ways, ranging from funding working capital requirements, funding losses of the business, incurring capital expenditure, to many more. These capital providers provide money in exchange for a particular ownership in the company, with the thought process that in future, if all goes well, the value of their stake in the company will be much more than what they have invested in the business initially. But have you ever wondered how these venture capital and private equity investors evaluate whether they should provide money to a particular company? And if yes, whether they should provide money at what valuation, and therefore how much stake should they acquire in exchange? In this video, we will try to understand how are these consumer startups evaluated. At the core of it, look, a potential of a startup can be evaluated by two categories of factors. Let's call it tangible and intangible factors. Tangible factors mainly include total addressable market and return on equity profile of the business. These two elements cover all the tangible factors required to evaluate the business. The reason why I call these as tangible factors is because these are somewhat measurable and one can use some bit of assumptions to model these in some shape and form. On the other hand, intangible factors mainly include factors which cannot be easily measured, right? These are mainly founders and the team, right? Now, whether they have what is required to be successful in the space, whether they are innovative enough, etc. And the second further factor is corporate governance and oversight. Whether they are running the business in a nice, legal, and a compliant manner or not. These are the factors which are good to have, much more like hygiene checks to be done before making an investment, but rarely can anyone predict how these will pan out in future. For the purpose of this video, we will focus more on tangible factors, right? Let's break down these two factors. The first one being total addressable market, or like people call it TAM. This refers to the size of overall market that a business can cater to. Now this includes multiple things, right? And let's look at each of these items one by one. The first is the product. Let's take a few examples to understand this. Look, if you are a retailer, right, selling goods which are similar to a mom and pop store or a kirana store, right, near you is selling, then the total addressable market to begin is very, very large for you, right? To put it into numbers, you're operating in a $1 trillion TAM in India. Whereas if you are a product company and that too you're selling in a niche category, which is, let's say, tea, right, then the TAM to begin with is relatively much smaller. For example, the TAM of tea in India is somewhere close to $4 billion. Or if you're selling eyewear, then the TAM is somewhere around $3 billion, right? Let's keep breaking down this further. The second element is the price point, right? This actually dissects the TAM by the paying capacity of the people. To understand it, let's take another example, right? The kind of audience which L'Oreal is catering to, right, versus the audience which Clinic Plus is catering to is very, very different. One is mass premium, the other is completely mass product, right? Similarly, in retail, the kind of audience which a DMart is catering to is very different from the audience which likes convenience and here therefore are the users of quick commerce platforms like Blinkit, Zepto or Instamart. The third element which breaks down your TAM is the distribution model that you follow, right? For example, if you're selling your products only on online platforms, which is Amazon, Flipkart, or the similar likes, right? Then your audience to begin with gets restricted by the people who are tech savvy, who know, who own a smartphone and know how to purchase the products online. Similarly, if your products are sold only and only in a physical store, like a kirana store near your house, you need to only consider the population living in the area and exclude the people who only transact online, right? And another element of distribution is that it also need to factor in what is your current and the potential reach across, different pin codes or cities or states. For example, if I am starting a business which all throughout will only cater to people in Maharashtra or Tamil Nadu, right? Then I cannot take India TAM to begin with. I will have to dissect it further by the relevant market that I'm catering to. This is what people or industry veterans like to call a top-down approach of computing TAM. They take product, they sort of further dissect it by price point, they dissect it by the distribution model you are following, and it gives them a quick and back of the envelope math, of understanding what is the true market potential of the kind of product that you're going to serve in the market. It goes without saying that larger the market size, higher is the probability of the business to create a successful and large size outcome. However, TAM actually has another element, two more aspects which I've mentioned and I've not spoken about yet, right? Which is competition and regulatory affairs. What I mean by it, let's take tea as an example again, right? While you can choose to sell, let's say, a best tea with the best flavors at the best price point, and it offers a decent size opportunity, right? The industry is something which has multiple organized and unorganized players. The minute you launch your product, you are actually fighting against the biggies, right? So unless your product, price and distribution is something unique and it's not solving a unique problem for the customer, your potential remains very small, right? Because you are fighting against the guys who have created dominance over last 40, 50, 60, 70 years, right? And the customers are used to consuming their product. And so therefore, the higher the competitive intensity, it's more difficult for you to win in that market. The second is regulations, right? Now, let's say you are stepping into an industry which is comparatively very, very regulated. Let's take baby food or milk as an example. If you try to do anything which gets a lot of attention of government, right? Then just be aware that government possesses the complete freedom to pass any act or legislation which can completely mess up with your business in a span of a minute, right? Let's quickly move to the second tangible factor, which is return on equity. Look, at the core of it, each business is out there to make money and profits, right? While capital provider provides you capital in the beginning basis the potential of the idea, he's also sitting back and realizing and thinking how much the business can generate return on equity in the long run. Now, you might have heard about terms like PAT or EBITDA or margin, right? And they all sound very fun and cool. The real juice of any startup actually lies in the return that can be generated in the form of capital, and that to the equity shareholders of the company. To compute ROE, the formula I've mentioned is quite simple. It's earnings upon sale, or what you like to call as PAT percentage, multiplied by sales by assets. This is the asset turnover ratio, multiplied by assets upon equity, which is how you are funding your capital, whether it's by equity or debt or a mix of both, right? For this video, I'll ignore the third element and let's first try to understand the first two elements with a simple example, right? Let's say, there are two people, Ram and Sham, and both of them have been given 100 rupees at the beginning of the day. The task at hand for them is to run a completely legal business and generate maximum return on the 100 rupee given to them, and they have 24 hours to do so, right? Let's look at the strategies each boy takes, right? So Ram actually uses his 100 rupees to buy 2 sets of earphones, and he starts pitching to people to buy these earphones at 70 rupees each, right? It's a smart strategy because he's playing in a category where a lot of price discrepancy remains, right? And look, he's gunning for 20 rupees profit margin on each product, which is effectively 40% profit margin. It's a sweet deal if he's able to sell these products. Now Sham, on the other hand, used his money to buy 5 packets of milk for 20 rupees each. And he used his innovation and he started reaching out to all the houses in the vicinity and started selling them packets at 21 rupees, which is 1 rupee more. People were happily paying him 1 rupee extra because he was delivering the products at their doorstep, right? They didn't have to take the trouble to go out to the kirana store and buy the products. So at a product level, while he was gunning for a mere 5% profit margin compared to Ram, who was running for a 40% profit margin, it looks like Sham is not doing the right thing, right? But the things are not straightforward, right? Because look, at the end of the day, Ram was only able to sell 2 earphones, because not many people, actually start their day and think of buying earphones. Whereas milk, on the other hand, is a fairly commoditized product. You use it almost daily, right? So while Ram was able to sell only 2 earphones, Sham was able to sell 50 packets of milk. Now, you may ask, did I give more money to Sham to begin with so that he could stack up 50 packets of milk? The answer is no. He only had 100 rupees to begin with. But as and when he was making a sale with that cash, he was going back and buying more and more products of milk, right? So when you look at the P&L, Ram has done a great job in creating a higher margin. But by sheer operating in a category which has much more movement, much more frequency, Sham was able to sell much more products, and therefore at the end of the day, Ram has 140 rupees of cash balance, which shows a 40% ROE profile. Sham has 150 rupees of cash balance, which shows a 50% ROE profile, right? So I hope this makes you clear what is the difference between the profit margin and the ROE profile. The ROE profile also takes into account how quickly you are moving your money, how quickly the cash is being rotated, right? And now going back to how investors look at these things, investors usually keep an eye out whether a business is fairly capital intensive or capital light, and what are the working capital requirements for a business. That's how they decide what will be the return on equity profile of a particular company. I'll end this video with a very important lesson, which is that it's very important to balance TAM and ROE, right? Let me explain you again with an example. Imagine you start a business of selling healthy shakes, milkshakes, and your healthy milkshakes are made of oat milk, right? It's quite healthy, it's high, your cart is quite hygienic, and you have an amazing taste, right? Which you are able to sort of sell in the form of your milkshake, and you price it at 500 rupees. You are able to generate 20% ROE from your first cart, right? Now, given the expensive price point, weather condition, let's think only 100 people in your area have a 2 potential to ever come and buy your product, right? Which means while you are working at a very smart ROE, your TAM is very much restricted. Does that mean that your business will be is investable? Will you be able to get a lot of investors? The answer is no, right? Because at the end of the day, the TAM potential is very, very small. Now, let's think that you dropped your price of milkshake, right? For 500 rupees, you dropped it down to 50 rupees. Now, obviously, it comes at a cost of maintaining certain hygiene or freshness or taste. But at this price point of 50 rupees, let's say you are able to cater to 10 lakh people in a particular area, right? So wait, now the TAM is massive, but because you dropped your selling price so much, you are actually generating very thin ROE, right? Let's say you are generating 5% ROE. Is your business now investable? The answer is no, because now the reasoning is different. While you are operating in very large TAM, the ROE profile is so meaningless for any investor to come in and think that he'll be able to make a lot of money in this sort of company. So it's very important to balance TAM and ROE, and that's the struggle which each business sort of faces. Thank you so much, everyone.